please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The most significant decision pertains to the national carrier, that is Air India. In its bid to find a buyer for the debt-ridden national carrier, the government has opened the doors to foreign carriers to buy a piece of Air India. Earlier, foreign carriers were not allowed to own any shares of the company. Now, they can own up to 49%, provided they obtain the government's approval. Now, foreign carriers cannot invest more than 49%, as that limit suggests. So, the other 51% must be owned by an Indian entity, which will also retain effective control of the airline. Aviation experts have welcomed the move, and Commerce Minister Suresh Prabhu believes that the centre has removed a major roadblock in the Air India divestment process. Here is what Suresh Prabhu and a whole host of experts had to say to us earlier.
Cabinet has decided to remove some of the roadblocks in terms of getting foreign direct investment into India. As you are aware, FDI facilitates faster development of Indian economy. FDI denotes the confidence of the foreign investors into Indian economy. FDI brings technology. FDI brings in necessary investments.
This policy is a very welcome one. It will facilitate, make things easier, the disinvestment process. Considering the debt, the losses that we have on one side, which are, in my opinion, spoken far too often and given far too more prominence, the reality is that Air India has a lot of value for an aviation company. I agree with the government on this, that you cannot give management control of Air India to a foreign airline.
Till now, foreign airlines could take equity up to 49% in an Indian scheduled airline, but not in Air India. That restriction has been removed.
Okay, so let's put this into perspective. FDI rules have been eased for Air India, yes, but who really wants to buy Air India? As things stand right now, the government has only one official expression of interest. That is from the domestic carrier Indigo. However, Indigo has stated officially that it is mainly interested if the government agrees to a piecemeal sale. Indigo does not want to buy all of Air India and has its eyes very clearly set only on the overseas operations and budget flights operated by Air India Express. Now, the other player that could be in the race is Tata Sons, who is another potential suitor. Tatas, who owned Air India 70 years ago before it was sold to the government, could throw their hat into the ring along with their current partner, Singapore Airlines. In fact, Tata Sons chairman N. Chandrasekharan told CNBC TV18 earlier that the group will, and I'm quoting him now, definitely look at the Air India divestment proposal. Now, the CEO of Vistara Airline, which is the joint venture between Tata's and Singapore Airlines, has also said that they have an open mind as far as buying any stake in Air India is concerned. So far, no foreign carrier has expressed outright interest in Air India yet. The government has appointed advisors for the sale, and a group of cabinet ministers led by the Finance Minister Arun Jaitley is currently overseeing the process. We need to keep a close watch to see if any foreign players would be interested after this important announcement. But Air India was not the only company to get the gift of easier FDI rules. Companies operating in the single brand retail space also saw the doors to foreign investment open a little further. Now, as you could remember, 100% FDI was allowed in this space already, but only after prior government approval. Now, a foreign single brand retailer can enter the country with full ownership and control without seeking prior government approval. As an added sweetener, the government has eased up on the 30% mandatory local sourcing requirement for these companies, giving them a 5-year holiday if certain conditions are met, that is. For one, the quantum of this relaxation will depend entirely on how much the foreign retailer increases its local sourcing from India for its global operations. Also, this relaxation is brand specific, so the relaxation availed by sourcing goods for sale under one brand will not apply to the sale of another brand by the same retailer. Now, Indian retailers have welcomed these relaxations, but add that these changes will not result in any major shake-up or consolidation in the industry. Listen in to some important voices.
It should be clear that government is not going to make any compromise on the requirement of local sourcing, which is 30%. What the government has said is that those single brand retailers who are also sourcing from India for their global stores and global market, for their incremental increase in that global sourcing, they will be given credit for the first 5 years, but they will have to comply with the 30% local sourcing requirements.
That is a very positive move. We have been asking for it because if we want that agriculture diversification happens, there is a development of value chain in agriculture. That's not possible without mechanism like contract farming. Private sector participation in agriculture is very, very low. Out of the total investment made by corporate sector in India, only 0.5% is made in agriculture. We need to raise it, at least double it.
I think it is done with the Davos meeting, which is likely to happen in the next 10-12 days. And I think it's a good signal internationally if you want to attract foreign capital, foreign investments. And I'm not talking of FII, I'm talking FDIs. I think this is a very good move, and I think all this will send the right signals to foreigners. So I personally think that this is a good, very strong and good signal which the government has taken and not waited for the budget to happen. I don't think it's more at the retail level, it's not at the FMCG level. So I think there will be more increasing competition at the retail level, and we have to see how that pans out, and that overall contribution of the modern trade to the FMCG sector may go up because of that.
Now, apart from single brand retail, FDI rules were also relaxed in 3 other sectors. For construction, 100% FDI will not be allowed through the automatic route. Earlier, government approval was mandatory. So that hurdle has now been removed. The government has made a distinction between real estate and real estate broking services. So 100% FDI through the automatic route has been allowed for realty broking industry. And finally, for power exchanges, the 49% FDI cap remains as is, but purchases can be made through the primary market. Earlier, FDI was allowed only through the secondary market, and that restriction has now been done away with.